Hello, everyone. This is Nicholas Shaheen, Vice President and Financial Advisor at Financial Services of America. We had an eventful second quarter with some ups and downs, but mostly ups. After closing at record levels at the end of the first quarter, markets stumbled as we entered April. It has been the same theme all year so far. Stubborn inflation, a decent economy, and a strong jobs market have all conspired to keep rates higher and the Federal Reserve on the sidelines. The Fed and markets continue to react to economic data for insights as to what's to come next. We went from expecting 6 or 7 rate cuts at the beginning of the year to 2 or 3 in the middle of the second quarter to only 1 sometime by year end. The economy slowed in the first quarter. We finally got the first reading of gross domestic product, or GDP, in April, showing an anemic growth of 1.6%. Then, the second revision in May was even weaker at plus 1.3%. Yet, job and wage growth continue to be robust, while inflation is stuck around 3.5%. That puts the Fed in a strange place. Does it continue to keep rates where they are or try to push inflation toward the stated target of 2%? So far, rates at these levels have slowed economic growth. If we consider the first quarter GDP, then the Fed is getting it right. But if we consider inflation, it's nowhere near the 2% level that the Fed would like to see. After initially driving inflation down from 9.1% rate in June of 2022, we have mostly been in the 3 to 3.5% range on the CPI since November of last year. We received some cooler inflation numbers from May, but the progress to 2% seems to have stalled. Gas prices have declined significantly in June. I've been saying that energy costs contribute significantly to the cost of goods and services, and despite the welcome relief in the form of lower prices, energy costs are not impacted by the Fed. Plus, they're highly volatile and can change on a minute's notice. Oil ended the quarter at around $80 a barrel, and many economists and strategists are calling for oil prices to go up in the coming months. That leaves the Fed unable to cut rates for fear of reigniting inflation, while wanting to cut rates to strengthen the economic growth. So, the Fed did nothing again in the second quarter, while the markets kept lowering expectations to the point where one rate cut sometime in the next 6 months seems irrelevant. Are higher rates that bad? Well, in the second quarter, the market didn't seem to think so. The S&P 500 and Dow and Nasdaq all notched record highs. Each index added to strong first quarter results. The S&P 500 moved up over 3% in the quarter and over 15% on the year so far. The Nasdaq was up almost 10% in the quarter and nearly 18% so far in the year. The Dow has been flat and up only a couple percent so far this year, but the Dow is not as representative of the broader market as the S&P 500 and has been hampered by laggards like Boeing, Intel, and McDonald's so far this year. It really has been a very interesting story as to who has performed really well so far this year. So maybe the Dow is not so old-fashioned as we may think. The biggest stock story this past quarter was Nvidia, which overtook Apple and Microsoft as the largest company in the world, on the back of excitement around AI and the chips that will power its adoption. Market breadth has been very narrow, meaning very few companies are responsible for the gains we're seeing. But if they're in the index you're invested in, you can potentially be rewarded. I keep hearing that this is a stock picker's market and that there are going to be distinct winners and losers. So you had to avoid the passive alternative or index, or just find a manager or a strategy that'll find you the winners and avoid the losers. To me, that's no different than market timing and just as ruinous. In fact, if you would have invested in the broader based index like the S&P 500, you were likely rewarded even in the narrow market because it is diversified and held big winners like Nvidia, which helped the overall index while other members were flat. We all know that'll change. Being concentrated in 1 or 2 big winners can cost you in the long run as the rest of the market begins to catch up. Earnings for the first quarter, which were reported in Q2, were much better than expected and show that so far companies are negotiating this higher for longer rate environment successfully. A lot of recent earnings success is due to a resilient U.S. consumer that continues to spend, but the signs of fatigue are showing as the savings are depleted and credit card balances rise. This is a sign of concern because if we lose a consumer, we most likely will dip into recession. For now, that doesn't seem likely, but on the balance, there is more to be concerned about than optimistic with respect to the consumer. The yield curve has been inverted since last year, but near-term yields have been a nice alternative as people get increasingly nervous about the market. The yield on the 10-year Treasury has hovered around 4.2 and 4.7% the entire quarter. Although from a total return standpoint, bonds didn't really deliver a whole lot last quarter, still the ability to invest in a CD paying 5% or a money market yielding over 4% is almost a novel idea after nearly 2 decades of rates at zero. Summing it all up, the past quarter has built on and continued the momentum of the first quarter, and the first half has been a pretty good one for markets. Every time we hit records is a good thing, but people do get nervous because they start thinking we're on uncharted territory and we may have a correction or sell-off. That is always a possibility, but remember, markets don't go up in a straight line. Instead, they have an upward bias over time, and volatility is a natural part of normally functioning markets. This is why you have a plan, and if you are uncomfortable, have an honest discussion with your advisor about the type of risk you are willing to take, and if needed, adjust your approach. I will say that you cannot expect the same kind of returns in the market if you're not in the market, so some risks must be accepted for potentially higher returns. If you have been letting things ride and are out of balance, get yourself back in balance with your goals ASAP. We may be in for some turbulence in the second half of the year, so turn off the cruise control and take firm hold of the wheel. I'll be back with you in the fall and we'll see how things shaped up over the summer. Last quarter I said staying the course and being disciplined will be rewarded again in the second quarter. I think that turned out to be pretty good advice, so I'll double down on that same advice. Stay diligent, review your goals with your advisor, and make sure you're staying on track. Don't succumb to the emotion or hype and stay the course. Please reach out to your advisor if you have any questions and make sure your goals and objectives are aligned with your plan. Thank you and have a great day.